Hello, I am Professor Lynn Weichert, and welcome back to Introduction to Budgeting and Financial Management for Nonprofits. Today we're going to discuss principles of accounting. The American Institute of Certified Public Accountants, AICPA, created the Financial Accounting Foundation, which is an independent nonprofit that has responsibility for setting accounting for government entities, publicly traded companies, and nonprofits. Financial Accounting Standards Board, FOSBA, sets the standards for financial accounting and reports for all non-governmental entities, and GASB, or Government Accounts Standards Board, sets accounting standards for state and local government entities. The Financial Accounting Standards Board, FOSBA, issues rules, which are principles of accounting, meaning generally accepted accounting principles, called GAAP. You will find that the audited financial statements of a nonprofit will have a letter from the Certified Public Accountant, the CPA, who has audited the nonprofit, stating that the financial records of this nonprofit are in conformity with accounting principles generally accepted in the United States. If the auditor does not say this, then there are problems with the nonprofit's financial record keeping. Why are accounting principles so important? In order for anyone to make financial decisions about their personal investments or their investments at work, it is necessary to have consistent and comprehensive information about the entities that one is examining. For example, if a company valued its inventory at a very low cost, then the net income would spike. GAAP does not permit such manipulation. The same is true for overestimating revenues or waiting to record expenses until next year. These are not allowed under GAAP. Of course, that does not prevent fraudulent behavior, but the rules are clear, and CPAs are trained to find fraud. There are different ways to organize these accounting principles, and I divide these rules into 4 principles: cost, revenue, matching, and disclosure; 4 key assumptions: economic entity, going concern, monetary unit, and time period; and 4 basic constraints: objectivity, materiality, consistency, and prudence. I am not going to discuss all of them, and I'm sure you're relieved to hear that. However, there are a few we must review. I want to be sure that you understand these few. But first, let's talk about cash and accrual accounting. Before we can talk about accounting principles, we need to talk about the difference between cash and accrual accounting. Cash accounting is tracking transactions that use cash. Accrual accounting is tracking all transactions, whether cash is used or not. For example, if I pay a corner store for the New York Times every day on my way to work, these are cash transactions. I paid the owner, he gave me a paper. For me, that's an expense, and for him, it's a revenue. The next day, let's say I had no money, and I said to the owner, "Can I have my New York Times, and tomorrow I will pay you back?" And he says yes. Now we have transactions without cash changing hands. That's accrual accounting. For me, that is an expense because I owe the owner money. And for the owner, that is a revenue because he assumes he'll be paid tomorrow. So accrual accounting is when we count every transaction, even if no money changes hands. Why should this be important at all? Because if I were the governor of a state and stopped the state agencies from paying all their bills for a couple of months, I could, under cash accounting, end the year with a cash surplus. And I could say I had a surplus. However, under accrual accounting, I would have a deficit because I have lots of bills that haven't yet been paid. In cash accounting, we only count transactions when money changes hands, and thus we would not count liabilities. However, in accrual accounting, we count liabilities as transactions. Most nonprofits use some form of accrual method of accounting, which focuses on when revenue was actually earned and when expenses were actually incurred. For example, let's say you hire a grant writer to write a grant proposal in April, but the bill for these services is received by the nonprofit in July and paid in September. Since the expense was incurred in April, under the accrual method of accounting, you would record an expense as an accounts payable in April. You count it as expense even though the bill and proposal had not yet been received. So now let's talk about the cost principle. The cost principle, or rather the historical cost principle, records assets at the time the asset is bought. This means that when a nonprofit buys a building for $500,000, the nonprofit will not record any increases in that investment. Let's say that 10 years later that building is worth $1 million. The balance sheet will only reflect the historical costs plus the accumulated depreciation over those 10 years. There's interesting debate about replacing historical cost with fair value cost, market cost. Historical cost is popular because it's a conservative estimate of the worth of an asset. Fair value cost is popular because it's a more accurate representation of the worth of an asset at that time. There's an exception to the historical cost rule. When the nonprofit invests in marketable securities or stocks, that's an asset, these stocks must be recorded not at historical value, but the value they were worth at the time of the balance sheet recording, presumably at the end of the nonprofit's fiscal year. Unlike fixed assets such as buildings, the market value of stocks changes frequently, so fair value makes more sense. In addition, the cost principle means that the nonprofit cannot declare an asset if it was not acquired during a transaction. What does that mean? Well, a trademark cannot be declared an asset and assigned to costs. So Coca-Cola cannot declare that it has decided its trademark is worth $100 million. It is not on the balance sheet at all. Now let's talk about the revenue principle. Revenues are recognized when they are earned, no matter when cash is received. What does that mean? When the public broadcasting system has its annual pledge drive, in accrual accounting, those pledges are counted as revenue, even though the pledges haven't been paid. We also deduct a bad debt allowance of a certain percent, such as 2 or 3%, to account for those pledges that will not be paid. Let's talk about objectivity. This is the concept that the financial statements of an organization have to be based on solid evidence. The intent behind this principle is to keep the management and the accounting department of an entity from producing financial statements that are slanted by their opinions and their biases. This is why nonprofits must change their auditor every 5 years. It's important that nonprofits do not keep the same auditor for decades. After a few years, auditors can lose their objectivity and may allow decision-making about counting revenues and reducing expenses without adequate proof. Let's talk about prudence, or what I call conservatism. Of all the accounting principles, prudence is the most important. Some of you will someday be the executive director of a nonprofit. When that day comes, you need to be conservative about your resources. This is not a political stance. This is a financial one. When you are protecting your revenues in your new budget for next year in your new nonprofit, it is your job to estimate your revenues conservatively. Do not make wild assumptions. Make prudent ones. When you are estimating your expenses for your new budget, be prudent. Do not assume you'll be able to keep your expenses low and thus balance your budget. Be realistic. It is better to talk to your board about a projected deficit ahead of time than to walk into a board meeting halfway through the fiscal year and say, "We have a problem. I am projecting a deficit. Some of my revenues that I thought we would collect are not coming in." So be conservative in your revenue projections and be conservative in your spending. Remember, it is not your money. If you wish to take risks with your own money, that's fine. But you have fiduciary responsibility for a nonprofit, so be prudent. That's all for today. Please read about all the other principles in your textbook and do the exercises at the end of the chapter. And I'll see you in cyberspace. Goodbye.